Welcome to ETM Analytics and Treasury One's weekly market review with myself, Ilse Marie Leroux. I'm joined today by Wichard Cilliers. He is the head of market risk at Treasury One. Wichard, so apart from the attack that we saw, which was launched from Iraq on a US military base into Syria, some of the tension about the concerns that existed about a wider spread or the extension of an escalation in the Middle East seem to have eased a little bit. And of course, we are seeing that in the oil price, which pulled back a little bit following last week's knee-jerk reaction to the whole Israel-Iran back and forth.
Yeah, good morning, everybody. So last week we had a little bit of volatility in the markets. We've seen oil prices, and we saw it on Friday morning, actually. We saw oil prices up 5%. We saw gold spike. We saw a lot of emerging market currencies under pressure in early morning on Friday when the retaliations from Israel apparently on Iran strike. However, it was downplayed. There isn't much happening. So we've highlighted a little bit. Oil went above 90, but it's back at $86 now. It didn't breach the previous month intra-month high at $92. So it's still on the easing way down because people are still worried about demand longer term, and there's an ample supply coming from the OPEC Plus countries. So tensions in the Middle East a little bit less this morning. Oil prices down, gold down. Yeah, so it looks a little bit more rosy this morning than we woke up on Friday morning.
The oil price, obviously something that the central banks will keep an eye on for that inflationary pressures. But before we get to the inflation, let's just move over to the US, where they will be releasing Q1 GDP figures later this week. And for all our anticipation of some form of landing, the US economy is proving the exact opposite. Now, whether this is the pandemic stimulus propping up the US economy or not, we're expecting another strong print to come out for Q1. And this is an impressive streak for the US.
Yeah, so they're expecting the economy to grow like 2.8% for Q1 again. If you look at the chart, you'll see the last 6 quarters were all above 2%. The red line indicates a 2%. They had that little wobble. So everybody's still working for the US to go into recession, but it looks like their little wobble in recession was actually in 2022. So they're still expecting to grow at 2.8%. It's the 7th straight quarter above 2%. You need to go back all the way to 2003, 2004 to get another streak of 7 quarters in a row of 2% plus. So the better part of 2 decades that we're looking at for 2% plus growth. And it just shows you how strong the US economy is. This US exceptionalism that everybody's talking about is definitely alive and well. So there's no need for the Fed to look to cut rates. The economy is growing. They're creating jobs. Unemployment is at lower rates. So why do they need to cut rates? The rest of the world, they a little bit of a different juncture at this stage. But yeah, let's not run ahead of ourselves. Let's see what happens with US GDP.
You mentioned now about the cutting interest rates. Obviously, we know that the Fed will be watching the PEC quarter-inflator later out this week as well. And as like with the GDP figures, we are kind of expecting that the inflation will remain still at a robust momentum in the US economy, and nothing much has changed.
Yeah, so if you just look at the chart at the moment, you'll see that inflation rate still remains elevated. If you look at the UK, the Eurozone, the US all sort of targets 2% inflation. They're all running above the 2% inflation. I've put in South Africa just as an indicator. We want the band of between 3 and 6%, but ideally our governor would like it closer to 4.5% mid-band. So the PCE deflator that comes out of the US, that's the metric that the Fed likes to look to see what happens with inflation. And that is expected to come out a little bit higher than expected. They're expecting month on month to rise 0.4%, which will put the PCE inflator back to closer to like 2.8%, which is a little bit further away from the 2%. So again, the rhetoric that will come out from the Fed, they'll watch it. They'll see it's still above the 2% target that they want. And they'll just continue on this rhetoric that they've been battering for the better part of 6-7 months now, is higher for longer. Although they sort of said we're going to look to cut interest rates in 2024 in November, and the market priced all these massive cuts that we've spoken about previously, they've trimmed it all the way back to one and maybe 2 cuts for the year. And if the inflation and this PCE deflator still continues to come out higher, who knows? Maybe we don't even see cuts this year. I've seen a lot of other guys trimming back on forecasts. And yeah, it's interesting to see what happens with this inflation numbers.
Yeah, especially concerning, the inflationary risks that's still out there with regards to 3 wars. We also saw the US, basically rubber stamping a new aid package out for Ukraine, Taiwan, as well. So it's going to be interesting to watch what the inflation is going to do and how the central bank is going to handle it. I have to say that we are having a debate in the office, and now we don't have a firm standpoint on this or viewpoint, but the debates are popping up whether or not this may just be the new regime, that this is the new normal, the high inflationary, high interest rate environment, that we could see a possible recalibration. But like I said, just debates at this point in time, food for thought, but we haven't, secured a viewpoint on whether that is realistically what our future could look like going forward. But speaking of the US, the strong US economic performance, the strong job creation, the high inflation, obviously then keeping high interest rates higher for longer, the dollar smiling all the way.
Yeah, so if the dollar just sucks liquidity back to the US with this higher for longer. If you look at, I haven't put the yen on, but I look at the yen this morning, they're targeting back at almost 155 against the dollar. And that's just things is the Bank of Japan needs to manage interest rates this week as well. And they're probably going to be no hike again. Although they hiked 19 March from negative to positive 0.1, they're not going to do anything this week. And you can see the yen currency is under pressure, the euro currency is under pressure, pounds under pressure, emerging market currencies under pressure. And it's just a function of this dollar. It's just, why do you want to take risk on yields elsewhere in the world if you can get it in the US? So it just sucks dollars into the economy. So the dollar, and everybody's just betting the dollar is going to continue to surge. And if you look at this chart, it's from the CFTFC, the long. So everybody's just buying dollars at the moment, and buying dollars and wearing diamonds, as the saying goes. So we think the dollar is a little bit stretched again, but we've been advocating it for a while. But if everybody buys the dollar, it's still the flavor of the month.
Speaking of currencies under pressure, where's the rand at for the week that we're looking for?
Yeah, so we've been advocating this drum as well for a while now, 1820 to 1920 broader range. We're still stuck in that range. We saw briefly Friday morning, we broke 19 into the 1935, 1936, what's about the high traded. We ended Friday back at the 1910 level, and this morning we're sort of hovering just below the 1910, 1908 level. We still advocate, think at the moment it's good levels for exporters. The dollar is the flavor of the month. But if you look at it, we've got a lot of proxy currency that we like to watch, and that's the Aussie dollar against the rand. And if you look at Aussie dollar against the rand, that currency pair hasn't really moved from about 12.25 for the past month or so. So it just shows you the rand's actually just been moving to what happens in the dollar markets, nothing significantly on its own. So if the US starts cutting rates, and we're saying it, we will probably see the rand stronger. So at the moment, above the 19 levels, it's good levels for exporters. Importers, again, if it gets closer to the 1880s in the short term and lower, it's good buying levels. But for now, nothing's really changed on the currency front, and the rand will still happily trade in this range. So yeah.
And I think investors might be careful in holding back as we head into the crazy election season. So it's an interesting year ahead, I think, for both South Africa and the US with that regard. But Vichar, thank you very much. We will catch up again next week as we watch things unfold in the US and elsewhere as well.
Thank you so much, Elizabeth. Bye-bye.